As the year winds down, it's a perfect time to reflect not just on what we've earned, but how we give. Strategic charitable giving can be a powerful way to support causes you care about while also trimming your tax bill. Today, we're unpacking the smartest ways affluent retirees and near retirees can finish strong with generosity and efficiency. Whether you're already a seasoned giver or just starting, this episode will sharpen your strategies and inspire thoughtful action. So Spencer, today we get to actually come back and re-record an episode that we recorded earlier this year, but then the one big beautiful bill came out and we have to adjust some of the things that we talked about in this about qualified charitable distribution, standard deduction, the enhanced senior deduction. So today we want to come and talk about charitable giving at year end. And so we've got a couple things that we're going to walk through: QCDs, donor advised funds, clumping and bunching, involving your family. But let's start off with qualified charitable distributions. And the reality here is we want to encourage and empower clients to be charitable. And a QCD is a great way to do it. You want to talk us through that?
Yeah, so a qualified charitable distribution, once you attain the age of 70 and a half, that magical birthday, you have an opportunity to be able to make gifts directly from your IRA to a charity of your choice. It has to be a 501c3 institution or other qualified charity. It can't be a donor advised fund, so you have to make that direct gift. But that will keep that gift from being included in taxable income. So we're taking pre-tax dollars, we're pushing them in that direction of the charity without taxation. And that's as good as it gets, because now we have a very high standard deduction that a lot of clients are not getting to, or they're not fully getting to use that itemization opportunity. So a qualified charitable distribution really is the tool that is the first tool that we would utilize there, because we don't have to worry about things from the one big beautiful bill and their ramifications as much. We're not worried about the enhanced senior deduction. We're not worried about the 0.5% of AGI that is being disqualified with respect to charitable gifts. All kinds of different things that are these little nuances and changes. Nothing changes that qualified charitable distribution, which is a beautiful thing.
Absolutely. Okay, so let's dovetail. We've talked about the QCD in the past before. You can always go back and watch other videos we've done about that. We love the QCD for folks that are 70 and a half.
And at the end of the day, if you have an RMD, a required minimum distribution, if you're 73 or older, have that RMD and you've got, let's say, $60,000 and you give away $30,000 via that QCD, that $30,000 is not taxed.
Yep.
But even still, even if you're just 71 and you have no RMD, we're still going to say 9 times out of 10, 99 times out of 100, use the QCD because it's pre-tax dollars to a charity of your choice.
Absolutely. All right, so the next one we want to talk about is giving appreciated securities instead of cash. So this is a way that a lot of charities will receive stock that maybe has seen significant appreciation. You don't have to pay the tax on it, but you get to give it to the charity. Talk us through why we should think about giving appreciated securities.
So if we don't have the option of the QCD, then we start to look at other ways that we can give efficiently. And the second way that we can give efficiently is giving a investment that has a lot of gain that we would otherwise have to pay tax on if we sold it. So if we have embedded capital gain there, but we give it away to a charity, we're not paying that long-term capital gain as we make the gift. Now, we'll talk about, the ways that you can make this gift. One is giving directly to the charity, another is a donor advised fund here in a moment. But giving those resources in that direction, you really get 2 tax benefits. One is that if you are able to itemize that on your tax return, you're able to knock down your overall taxable income. But secondarily, like we said, you don't pay the tax on the gain there. So there's a double benefit in that particular one.
Yeah, absolutely. There's a couple things that we need to really recognize here. When you're giving appreciated securities, you can't do this from your IRA or 401k. It has to be from an investment that is a taxable investment. So you're receiving taxes, you're incurring taxes on the dividends and capital gains on a year-to-year basis. Typically, these are called non-qualified or brokerage accounts. So you cannot do this from your IRA. We're sorry. The other piece is there's certain percentage limitations. You want to talk us through that?
Yeah, so for those appreciated securities, you can only give up to 30% of your AGI. So if your income is $200,000, your adjusted gross income $200,000, you would be able to give 30% of that. So $60,000 would be the maximum amount of gift that you could recognize on this year's tax return for an appreciated security. So, you could give away $60,000 of Apple stock that had appreciated significantly. And if you wanted to make an additional gift, it would need to be in cash to be recognized this year. Now, we do have clients that they will make a big gift in a year. It will go above and beyond 30%. And there's a carry forward process for up to 5 years thereafter. But we come back to usually not wanting clients to make that gift north of 30% of their adjusted gross income just to be able to get credit.
Right. And just again, coming back to one thing that you mentioned earlier, the 0.5% floor. Mm-hmm. For 2025, that doesn't exist. But in 2026 and beyond, there is going to be for folks that do itemize their deductions on charitable gifts, 0.5% of your AGI is not counted. So in that same instance, if you have $200,000 of adjusted gross income, 0.5% of that's $1,000. So if you gave that same $60,000 gift in 2026 and beyond, well, now it's actually only a $59,000 gift.
So I think the accountants didn't have enough work. So, they lobbied the legislators. I'm only kidding. Accountants would not do that. That's not what they're not excited about this. But in all seriousness, it is just one of these small elements that I think they added to tax law to make the numbers, dress them up, look a little bit better. But it is a small thing to be aware of. Yeah.
So if you're thinking about giving appreciated stock, 2025 is going to be a little bit more, give you a little bit more bang for your buck than 2026. But we wouldn't say don't give because of the 0.5% floor.
Sure.
So the next we want to talk about is clumping and bunching. And some of this also incorporates other strategies that we can think about, donate and replace. You want to talk us through clumping and bunching first, though?
Well, the big picture is for a lot of our clients with a high standard deduction, they're not itemizing anymore. So let's just say that you have $5,000 of property tax. You might have $5,000 of other itemized deductions there. And let's say you give away $20,000 in a year. That gets you to $30,000. Well, if you're married filing joint, you're still going to choose the standard deduction, which is north of $30,000. So we get to this point where clients may be giving charitably and even giving significantly charitably and giving $20,000 a year or more, but might be getting no credit for it. So what we can do in that circumstance is encourage them, if they have the capacity, to clump those gifts together in 1 year. So maybe they make their normal giving, if they do $20,000 of gifts in December, okay, make those gifts in December, but also make the next year's gifts that December. So we double that up. Or some other cadence in there. Or if they have the capacity, maybe even give 3 years all at the same time, and then be able to recognize, again, a higher level of gift that will actually get them above the standard deduction, so they get some credit, so to speak, for their gifts.
Right, absolutely. Spencer, one of the things that we've come up with, or we've started to see with clients, as we've looked at charitable giving strategies, if you are 65 and older, between 2025 and 2028, there's the reality that you have an enhanced senior deduction of $6,000 per person. This just kind of complicates things in some ways that we would say, if you are going to look to give charitably, try to get above and beyond that standard deduction, your bracket, if you're trying to also stay below 150,000, the amount that you can give is starting to get compressed a little bit with those 60% and 30% windows. So what we would say is, if you are looking to give, absolutely give. Don't let this slow you down, but really talk with your financial planner, talk with your tax accountant to see how, okay, if I take an additional distribution to get more that I can give to charity, or if I'm kind of at that line, how do I make sure I maintain that deduction? These are just things that we really want to consider over the next couple of years.
Yeah, and the complexity of the one big beautiful bill, that enhanced senior deduction kind of came out of left field.
Yeah.
We were not expecting that, but that $6,000 deduction, if you're at a 22% marginal tax bracket, that deduction is worth over $1,300 per person. So we want to pay attention to that, and it does complicate things in some different ways. So where tax planning used to be complicated, now it's really complicated there. And there are unintended consequences, I think, that if you've been doing tax planning even with us for the last 4 or 5 years, that this complicates some things. If we think about Roth conversions, because oftentimes we'll clump and bunch in a year that we do Roth conversions, may not make sense to do that anymore just based on that enhanced senior deduction. So if you have questions, don't hesitate to reach out to us about those. As always, because this is a little bit more complicated than it was in prior years.
Yeah. Okay, so let's touch on another piece of the clumping and bunching that we often talk about with clients is the donate and replace. And so we'll go back to that second strategy where you're giving appreciated security. Let's say you give away $60,000 of Apple stock. What's the donate and replace strategy?
Well, donate and replace would be where we give away the appreciated security and we replace it soon thereafter with purchasing that security. So let's say you have two different options. One is that you give away, again, in this example, $60,000 of Apple stock. You are able to wipe away, let's just say $50,000 of capital gain if your basis was $10,000. So that's a really nice benefit that you're not going to be paying that capital gain. The other strategy could be that you give $60,000 away in cash. Okay, that's fine, but cash does not have any capital gain, associated with it. So what we want to do is strategically think how we can make this work. If you have just been writing checks to, say, charitable institutions, instead, if you can give away the Apple stock and then use that cash that you might have used otherwise to make the charitable gifts, if you can then rebuy the stock, or let's just say, you had an ETF or a mutual fund that you're giving away that's a broader investment, more diversified investment. Same would apply here. You give away that and then you rebuy. So in essence, you are doing two transactions there to be able to wipe away that capital gain and have some really nice tax benefit. But the charity gets the same amount at the end of the day. So that stepwise process can really be helpful.
Yeah. So Spencer, one of the things that we come back to with clients, if they have a single security that's highly appreciated, let's talk about that Apple stock, and they want to be more diversified. Well, there are plenty of funds that are market-like funds that invest in thousands of different companies. And so if that client wants to then donate the Apple stock and then broadly diversify, there's plenty of investments that they can go towards that will buy more companies than just Apple. And so it's a great way to eliminate your single stock exposure and replace it with more market-like exposure. So one of the other pieces with this is unknown cost basis. You want to talk us through that unknown cost basis conundrum?
Sometimes clients don't know their cost basis. And this is an ideal time to give away that stock because they know, hey, I've got a lot of gain, but if I ever sell that daggum security and I have to report it to the IRS, I have no idea what the actual basis was. So we see this all the time with clients. They may have inherited stock. They may have bought stock, 30 years ago. It might be a small amount. This can be a great way to donate and then replace it with something else.
Absolutely. So another strategy that we see often used with the donate and replace, whether it's clumping and bunching, is a donor advised fund. And this is really just a vehicle by which we can make this gift possible. A donor advised fund, again, we've talked about these quite a bit, but what would you want to touch on about a donor advised fund?
Well, it's a charitable piggy bank of sorts. You make the donation there, and then you can hold it for as long as you might want to. So in a classic example, we would make 3 years worth of gifts into that donor advised fund. The first year, you parcel those gifts out over the course of that year, but you still have 2/3 of the value left to be able to give out in year 2 and 3, should you want to. So you get the tax benefit up front. As soon as you make that gift, officially, you get to declare that as a gift and itemize that if you get above that standard deduction threshold. So you get the tax benefit right away. Technically speaking, you no longer own it. And so the donor advised fund owns that, but you get to be the advisor of where those gifts are parceled out to over time. Again, could be within a few months, could be within a few years, could be 10 years down the road that you ultimately make those decisions of where those funds go.
Right. And there's a lot of other benefits to donor advised funds. It allows you to have one tax receipt that you send to your CPA. It allows you, if you want to give all the gifts in the same year, but again, only have one receipt, it's a great way to do it. Know that there's some fees and costs incurred, but it's a really, really nice vehicle.
To my knowledge, we've never had a client move to a donor advised fund and say, this wasn't worth it. Almost universally, clients will say, gosh, this made things simpler. Because to your point, let's just say you give that $60,000 of Apple stock and you want to give it to 5 different charities. Well, that one tax receipt that you receive and is handled seamlessly by those institutions that are charitable institutions, the donor that set up the donor advised funds, makes life so much easier. Then they parcel out checks to the charity, because if you're giving, to 5 different charities, at least one of those, maybe 2 or 3 of those, will have trouble with that stock gift. And you'll be wrangling them for a tax receipt or working with them on just getting it recognized in the proper way at tax time. It's just not fun. Right. So that donor advised fund can make things a lot easier in that regard.
Absolutely. So the last piece that we want to talk about is just this idea of involving family in charitable contributions. I think one of the greatest things that we can do if you are charitably minded is to be able to bring your spouse, bring your kids, bring your entire family into this conversation. That doesn't mean you're going to give to your grandson's favorite toy bank, but it allows this idea of generosity to spread across generations. And that's really transformative for years to come. We often talk with clients about if they're having problems with overspending, giving is a great way to break the power that money has over our lives. So whether that's encouraging son or grandson to come and, hey, let's talk about where do we want to give as a family at this year end, it can be really transformative on a family basis. Anything you want to touch on there, Spencer?
Well, it's so powerful, I think, especially as we work with loved ones in this, because it draws us together, and particularly with kids, it helps them to see the world in a little different way. If they're looking through a booklet, let's just say from Samaritan's Purse, and they see, okay, I can purchase a goat for a family, for $80, and help them to be able to have food, for the next many years. What a powerful thing to kind of contemplate and understand that dollars aren't just used for, Nike sneakers or for, going out and grabbing an ice cream cone, but they can be used for some really amazing impact, in others' lives there too. And so helping them kind of grapple with, how do I steward the resources that are under my care?
Yeah, absolutely. Well, Spencer, thanks for this conversation about charitable giving, especially towards year end. Clients, if you have questions about how do you facilitate your charitable giving, what is a donor advised fund, how do you do a QCD, if any of these are right for you, please feel free to reach out to us. As always, leave questions down in the comments below, and we'll see you again next time. If you like these financial planning videos, please share it with a friend, and if you have questions, go to our website at seriousretirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at seriousretirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.